Welcome back to the Eric Krown Crypto channel. Today, I'm joined by a good friend of the channel, Mr. Ted Talks Macro. As always, his socials will be linked in the description below. I highly suggest checking him out. He's a great friend and also a friend of Mr. Ed, which is how we kind of met. So with that said, I'm going to hand it off to you. Obviously, Ted, his whole thing is the macro, so that's going to be sort of the focus of today. And I just want you to run our community sort of through all of the events that you're looking at, especially in the short term, and sort of what your thoughts are on them are.
Cool. Thanks, Eric. Good to see you, mate. It's been a little while, but it's great to be back again chatting about
Indeed.
the markets. You've been nailing it with the content lately. Like every time I log into YouTube, there's a new suggested video. You're pumping it out. So massive kudos to that. So
Good time.
I'm keen to share what I think and try and provide a little bit of insight on something a little bit different to what you do. So you're all about the charts, but I like to try and identify what's driving those charts, I guess, from the macro side of things.
Right on.
So let's have a look at that today, I guess.
Yeah, just let me know if you need me to share a screen there for you.
Sorry, mate, I missed that.
Do you need to share a screen there?
Yeah, let's do it. Can I share that? I should be able to share that through the...
Yeah, should be.
Yeah.
I can plop it up over here. There we go.
Yep, there we go.
All right,
okay,
beautiful.
So at the moment, I've got the DAX up there, but quickly, I'll just run through the state of things. So turn this indicator off shortly. So the bond market has obviously sold off given that the fact that the Federal Reserve have stopped purchasing bonds as part of their quantitative easing program, and now they're looking to tighten. So that's why you see bonds selling off quite sharply over recent months. And as a byproduct of that, you see yields on a tear. So there's an inverse relationship between the two. As bonds sell off, the yield on those bonds moves higher to try and incentivize purchasing of those bonds. But no one's really stepping in yet. It'll be key to kind of watch what US Treasuries, US government bonds, what they do in the short term, because they could signal a bottom in equities. And as we know, equities are quite correlated to Bitcoin and crypto. So I'm watching some selling action or some lower price action in the yields to try and get a little bit of a bottom in equities. So if I compare, say, the S&P 500, let's look at the EAS actually. Futures contract, if I compare that over here, sorry, one sec. Continue right scale, new left scale. We invert that. You can see that they typically start to bottom or move in a similar direction. When you invert the equity chart, it typically follows what the bonds are doing. So bonds will find, the yield on those bonds will find a top, and then you'll start to see equities and obviously crypto, as they're strongly correlated, will start to find a bottom. So they move in the inverse to one another. So that's a chart that I am watching in the short term. I've got the weekly chart up, but it's just been up only lately. But there'll be a point where this thing tops out, and that'll be a good sign that equities perhaps have bottomed and crypto can see another leg higher.
Yeah, I have been watching that from a technical perspective. That is a good place for a nice little pullback.
Yeah.
I don't know if I'd necessarily call it a reversal just yet, but interesting to kind of see the relationship there. Yeah, exactly.
Yeah, it is a good level, isn't it?
Right.
Yeah, and as a byproduct of that, you'll see the dollar index has just been up only, and that's another one to watch as well. So as there's more incentivizing of selling US Treasuries, that you're converting those US Treasuries to the dollar, and that the demand for the dollar goes up. So the bond market being one of the world's largest market, as there's outflows from those bonds, they have to convert those bonds into cash, and that's the US dollar. So that's why you're seeing the US dollar pump higher, and that's all a byproduct of what the US Federal Reserve are doing at the moment, tightening their monetary policy. So just a bit of a background on why the US dollar is moving the way it is, and why treasuries are important to watch, I guess, in the greater scheme of things. Gold, pretty boring. Equities, you can see, obviously, boomer market.
Yeah, exactly.
But yeah, the ES and the NQ, the S&P 500 and the NASDAQ are kind of coming into support, but this week we've got earnings and next week we've got the FOMC meeting. So I'm very hesitant to, call a bottom in those just yet. I see,
Right.
the short term probably a little bit more choppy more than anything. I'd rather probably wait until the FOMC meeting passes to start calling any kind of bottom there.
Yeah. Again, from a technical perspective, if you're looking at traditional markets right there, this would be, if you want like the full on hopium, this would be the place where you'd expect a bit of a reversal if it is going to end up being bullish. By contrast, pressure does remain down in a downtrend, obviously. So
yeah. Where are you looking on, say, the ES? Have you been having a look at the ES for like ultimate support?
Yeah. So let me just bring it up on my screen. When I'm looking at it like long term, it's hard not to be bearish here and be looking towards like 3650, 3700 in the next year or so. But like I said, I will be very much wrong on that. If you see a move in the next couple of weeks here back above like 4460 or so, that would be good enough for me to call a major macro bear trap. But until then, I'm always going to favor the current trend, and the current trend is down right now. So to me, that's like a hard rule.
So you're looking kind of like this zone here.
Exactly. Yeah.
Cool. Okay. So what else have we got? Asian equities, they're following, kind of a similar path to the US. There was talk of, even uglier. There was talk of some monetary stimulus there, but I think that got cut recently. So, no dice there. Oil, just range bound for now. But overall, you can see why the risk off argument is quite strong at the moment. And I think given what's happening this week with earnings and into next week with the FOMC meeting, and if you want to have a look at the FedWatch tool, which shows you the implied probabilities of a rate hike, it's telling you that there's like a 97 or 98% probability that there's a 50 basis point hike in May. So that's
essentially the expectation.
Yeah. So once it loads slowly, you can see it here. So 97.6% probability of the Fed raising the current target rate by 50 basis points. And typically they only they will hike them by 25 basis points at any one time. So this is a double whammy, double rate hike. And that's showing you how serious, I guess, maybe before people thought they were bluffing, but now they're like, we're actually going to take this thing serious and try and tame inflation.
Ted, if you don't mind me asking, what is your opinion on the Fed just in general? Do you think they're doing the right thing here, or is that something that you have an opinion on? Just out of curiosity.
Yeah, I think they're in a hard place. So obviously the buildup of the massive debt levels during the free money, free cash, cheap cash period that was COVID-19, so March 2020 onwards, historically low interest rates, cash was abundant, and that was with the real purpose to get people out of trouble. But I think that the market took it a little bit too far, and you're seeing that with the asset bubbles everywhere. You see crypto, you see equities, you see house prices, the cost of everyday living. Perhaps that was taken a little bit too far, and that transitory period where Jerome Powell was adamant that inflation was transitory wasn't so. And I think maybe then they should have started to consider that inflation was persistent and it wasn't going to turn around, but they left it a little bit too long, and now we're paying for that. So, yeah, the reason that they exist is to avoid monetary disasters like central bank disasters, economic disasters like recessions. So I think they'll do everything that they can to tighten as quick as possible, but without having too much of an effect on everyday living and the cost of living.
Do you figure that their main mandate right now then is to deal with inflation first and then support equity prices second?
Yeah, definitely. And I guess it's just whether they take into account that, the everyday person, it's just a hard place to be, because I think even in Australia, like mortgages are at all-time highs. Like every man and his dog is getting mortgages. So servicing that debt is going to become so much harder when they start raising rates. So they've got to take that into consideration, and no doubt they are. So it's just that fine line. Do they push it too far and make it impossible to live for people, and you have to sell your homes, and that leads to recession, and growth goes down in a downward spiral. So it's balancing that growth scenario with that inflation, like the growth of it's using these financial terms, you can get them mixed. So growth being the growth of the overall economy, getting that stabilized to a point where we're not going backwards and causing a recession, but we're still enabling people to service their debt, enabling institutions to service their debt without capitulating. So I think that's what they're trying to do at the moment. And, I'm no expert in how they're going to do that, but I'll just follow the data until I can spot moments where inflation looks to have topped, and then you can start to form a thesis from there. But at the moment, it doesn't look like inflation has really topped. But we could see that in the April data, which is past the peak of the war. Obviously, the March data was at the peak of the war, and everyone's expecting it to peak in March. So it'll be interesting to see what that CPI print is like for April. And I think that's the key data point moving forward.
I see.
Yeah. Long-winded answer there, but I think in the TLDR...
No, it's good, man. It's nuanced.
Yeah, they're in a pretty tough place, but I think the data is just going to lead them to those decisions. So last month we saw obviously inflation ticking up again. We saw the job market strong. All the data was very strong. So that, cemented the 50 basis point hike. And from now on in, they'll just be monitoring the data to see if that the market has repriced itself and whether that forward guidance is having an impact on what the market is pricing and how CPI comes in, how the employment data comes in, and how that evolves over the coming months.
Gotcha.
Yeah. So I think over the next week, you'll have the correlation between the NASDAQ and crypto be the number one thing to watch. So we have Google later today. So I'll bring up that correlation now. New price scale. Maybe the same percentage scale, actually. Apologies. Get it up.
No worries.
Same percentage scale. It's late in the day here.
All good, man. I appreciate you jumping on with this. It's good stuff.
That's good.
Especially today, seeing as... Yep, go ahead.
Sorry, you can see that correlation. Bitcoin and the NASDAQ. If we go, so the 1 hour chart, it's just insane. Bitcoin's essentially trading as a high beta tech stock at the moment. So over the coming hours, even, so I think up until Friday, we've got the tech giants releasing their earnings. So with the tech giants making up such a large component of the NASDAQ index, that's obviously going to move it about, depending on how those earnings come in. When we saw last quarter with Facebook earnings, that was just a shit show, and Bitcoin followed suit. Google should be okay by all reports, but it'll be interesting to see how the rest of them do go. Because I think YouTube and Google's overall platform has been really good since COVID, really, because YouTube viewership has just gone insane. You would have felt it firsthand.
Yeah. It's always difficult though with earnings, in my opinion, just because a company can come out and they can beat their earnings by a good margin, and they'll go down, and vice versa as well. They fail in their earnings and then they go up. So it seems to me like it's to me it's over my head. So I just try to be positionless going into these sort of events. Yeah, exactly. A bit more of a purist in that sense.
Yeah, for sure. So I think there's a bit of a tweet. So I'll just pull up a tweet that shows those events this week to visualize it.
Right on.
Let's have a look. Go back. There we go. So shout out to Tier 10K on Twitter. He's got the best news feed, I believe, on Twitter. So if you can see that there, we've got Tuesday. So Gary Gensler speaking at UK City Week. So he could say something off the cusp there. Microsoft earnings after the US close. Same with Alphabet and Visa. So obviously massive tech giants that make up that NASDAQ index. Wednesday, you've got ECB's Panetta talking about DeFi. So it just doesn't stop this week. It's insane. CME earnings, Facebook earnings, PayPal earnings. Thursday, we have Twitter earnings. Yeah, jobless claims in the US on Thursday. Robinhood, Amazon, Apple on Thursday as well. So after the close. So yeah, it's not going to let up until, probably mid next week when we get the FOMC out of the way.
Gotcha.
So but I think a lot of choppy price action is going to be seen this week. And we're in for a bit of a show.
I mean, that's what all my statistical indicators say. They say expect like big moves these next like 48 to 72 hours, actually, which is very interesting. Wow. I mean, they always just seem to match up with each other, don't they? Which is good.
Yeah, it's crazy. And it's funny when price comes into support or resistance, you get a key news event hit the headlines, like not even scheduled, or scheduled news goes one way or the other. Yeah, it's insane.
I mean, it's all a game, really. So it's to be expected.
It is, man.
At this point.
Is.
It's the best game around, though.
It is. Yeah, no day is the same, which is beautiful.
Indeed.
So visualizing the economic calendar, I've got next week up here because this week I don't think there's a whole bunch that can move. We'll look at this week first. I don't think there's really a whole bunch that can move the market significantly. You've got Australian data, but as far as crypto goes, there's not much that will move it. Maybe the core PCE price index, which is on Friday down here. That could move the markets because that's a key indicator of inflation that the Fed use. If that comes over the estimations, the expectations, that could cause a little bit of risk off across markets. But I don't think it'll be too significant. The market will be looking more to next week. The FOMC statement on Wednesday, you can see in the middle of the screen here. That will be obviously the key event, 6 p.m. UTC. So this is UTC time. Right. And then at the back end of the week, you've also got the employment data out of the US. But I think that will come in second to whatever happens on Wednesday.
Right.
And there was actually a tweet from a good friend, Miad, if I can find it here. Okay. Miad Khosravi. He had some stats on, so the Fed obviously tightening their monetary policy. He had some notes on what was actually happening with the US dollar as far as the notional value, the US dollar value of what US dollar was being pulled out of the market as a result of tightening. So that's very interesting. It's here somewhere.
Looks like it's partying.
A few funny tweets. Yeah. Jay Powell is about to draw $95 billion out of the market. So reverse money cranking, reverse quantitative easing, quantitative tightening. So every time you think the US dollar could go down, remember that next month, the Fed balance sheet is going to shrink by $2.2 million per minute.
Jesus Christ.
Yeah. So you can expect the US dollar to be supported on dips in the short term, I think, based on that fact alone. And obviously, it's doing just that. So it had a little bit of a dip, but you can see every dip's just being bought back up. And I think we had a bit of back and forth on Twitter on this, and we were targeting, I think I was looking at 104 roughly because I don't know, the chart looks pretty bullish.
It's hard not to be bullish on it long term. Yeah, I think you're going to be right about that, though. Probably more continuation. I was looking for a stop a little bit earlier, but I'm going to be wrong on that. I'm pretty sure. I think I'm pretty confident you'll be right.
Yeah. So if you take into account those macro drivers, it's like 22. What do you say? 2.2 or what was it? $2.2 million per minute is being drawn out of the market. So supply comes down, demand remains constant. Yeah. It's hard not to be bullish on the US dollar until I think we see some stabilization or more pricing in of this fact. Over the coming months. And I think the ECB will have a lot to do with the DXY topping because of the weighting of the euro in the dollar index. Right. So when the ECB start to hike, I think the dollar can start to form a top. And I think at the moment that's projected to be around July and into September, they begin their rate hiking. So we've still got a little bit of time before the dollar index tops out, I think. And that's another thing that's obviously putting pressure on crypto, putting pressure on equities.
Right.
Yeah, there's a lot to take in, and the environment changes so quickly compared
No
to
kidding,
this.
man.
This time last year, we weren't talking about any of this, so
Yeah.
it was just
Well, that's
up
why I
and
wanted
you
to bring
pump it.
you on, man. It seems like it's been a very popular thing recently that everyone's become like a macro expert, and
Yeah,
and realistically, I feel like this is something that you really need to put a lot of time into, like with anything. And you're one of those people, which
100%.
I'm happy to be bringing on. I want to just ask you a couple questions if you have time. I won't make them
Yep.
too long. Just out of curiosity, basically, I wanted to know. In like the most realistic environment, what would you say is kind of the best case to worst case scenario for sort of the short term here in the next couple of weeks, as far as events and price action goes?
Yeah, for Bitcoin particularly.
Yeah.
Yeah, so say price action. I think like that range bound scenario where we've got earnings this week, and we've got the anticipation of the FOMC meeting next week. I think we're very much stuck within this kind of range.
Mm-hmm.
Between 42K and the lows at 38.5.
Yeah.
So I think we chop about between there in a very predatory environment, with predatory meaning liquidations on the upside of the range and the bottom side of the range. Just stop hunting essentially. So I could see that being the kind of theme over the coming days. In the case that earnings really disappoints, you could see the NASDAQ puke through the lows over the coming days. So that's if and when scenario. And then I think Bitcoin could push down towards the bottom of the range, maybe take some stops, but I think the earnings alone won't be enough to send it into a downward spiral. We need to get some pretty aggressive commentary next week from the Fed. If they go, we're going to continue on with the theme of 50 basis point hikes and we're going to tighten really quickly, we could see a larger risk-off shift. So I think over the next 10 days, let's say the next four days to the end of the week, you got earnings where you might see a bit of a liquidation event towards the lows and a reclaim of the range. If earnings comes in nicely, you might see a push to the top of the range, but then a sell-off because you're anticipating next week's event. But I think with the fact that the FOMC is mostly priced in, the risks are that there's commentary that we don't know about. So if we don't get that, I think we get a push into 42K, and then it's going to need to take an extra hand to push it higher. And I'm not sure what that catalyst is yet. So I think the market knows what's going to happen at the FOMC. It doesn't know what's going to happen as far as the commentary. So that is the risk that remains, and earnings as well. So there's a few things that aren't really known. And if we get those things that aren't known, that will force the market to move sustainably in one direction or the other. But if we just get everything that the market knows, it's just going to continue to be range bound between 42K and 38.5K. I think something unknown is going to have to hit the market, whether it's an insanely good earnings report, which I don't think you will see, or an insanely bad earnings report, which you could very well see from the tech giants, or some really, really hawkish commentary from the Fed, which I think you could see, and that could push price, through the lows into 30K over the next week or so. So I think the risks are skewed to the downside, but the upside would be that we get something like either a really good earnings report or we get a really calm Fed. It's just about managing it as it comes at this point, because it's very much a trader's market. It's it's very hard. It's very predatory. It's got to take each day as it comes at the moment.
Absolutely, man. Yeah. It sounds like we got a lot of catalysts, especially in the next about 24 to 30 to 48 hours. It seems like also the whole deal with most of the stuff is expectations versus reality. And then if I could just ask you one last question, I know you have to go soon.
Yeah, man.
Just kind of like a fun one. What do you think about Twitter being bought by Elon Musk? Just like general thoughts, or if you have any thoughts on what that means for the general markets. Just curious.
I don't think it means anything for markets as such, unless he integrates BTC or Doge in a massive way. It might, which could very well happen. We never know.
Possible,
but as far as markets are concerned, I don't think it's a massive deal. It's more so the fun that we're going to see on what's going to happen to Twitter. Is he going to change it, like, totally in a different direction, or what's he going to do? It'll be interesting to see. I'm more excited for that than I am for its impact on markets, to be honest.
It seems like it's been a fun little time on Twitter the last 24 hours. Spent some good times, man. But I know that you are a bit time bound here. I want to be respectful of that. I also want to say a massive thank you for joining us back on this channel. I know that the community absolutely loves you, as do I. So as always, man, we'd love to have you back, when time makes it relevant yet again. And thanks again, Matt.
Appreciate it, Eric. Thanks for having me on, mate.
Absolutely. All righty, brother. Take care and see you soon.